This is Network 18. And you are watching CNBC TV 18.
That's commodity. Stock markets are beginning to come off again. The Sensex has drifted into the red. Subir Gokarn, Director of Research at Brookings India, is joining me now to talk about the macro, which has looked quite awful over the last few weeks. Subir, good morning. Good to see you again. Are you getting a little bit worried about how long this recovery process might stretch out? Because none of the numbers seem to be getting better. And now many participants are predicting a 5% growth again for this year.
Well, I think the combination of structural factors that have been dogging us for quite some time, essentially reflected in the almost what appears to be almost complete cessation of new investment, is clearly the proximate cause of this. And until we start to see investment recover, obviously I don't think we can have any expectations of a sharp or significant growth recovery. We'll have maybe some positive boost from a good agricultural season and so on, but those are not going to sustain a strong recovery. This is obviously now being compounded by the immediate pressures coming from the rupee and the policy responses to it, essentially in trying to stabilize the currency. Some growth risks have been exacerbated because interest rates are obviously have gone up as a result of monetary tightening. Ultimately, we've got to address the structural issues. We've got to bring the CAD down. I think we've been saying this over and over again, but it doesn't make it any less valid or true, that until you start to deal with the CAD, you're not going to be able to deal with the rupee. And until then, obviously, you're not going to be able to get back to the track that we were on a few months ago, which was to start to let monetary policy swing a little bit away from the inflation objective and a little bit towards the growth objective. And I think that opportunity now seems to have been constrained. So all of these factors are now imposing tighter and tighter constraints, and something needs to be done to break the shackles. And I think the first point of reference, the first issue that needs to be addressed is getting some movement on the CAD.
On the point about the rupee, Subir, many things have been tried. Interest rates have gone up in the system, but the rupee is trading at an all-time low at 61.5 thereabouts. Do you think more sterner measures are on their way? We need to probably tighten interest rates more to save the rupee?
I think the monetary response to exchange rates at best can only buy time. There are two ways of stabilizing and then strengthening the rupee. One is to increase the supply of dollars, which means expanding capital inflows in some way, and the other is to reduce the supply of rupees. Basically, you're making the rupee more valuable by making it scarcer. Now, that's the approach that was taken last month. Both obviously have an analytical foundation, but each one has different kinds of risks associated with it. And in this case, the risk is, as we've been seeing, higher interest rates and therefore negative impact on growth. But the fundamental pressure on the rupee is not because interest rates were too low or monetary policy was too loose. The fundamental pressure on the rupee is coming from the current account deficit. And unless we see that pressure point being addressed, these short-term measures will really not have any lasting impact, and that's why the short-term, that's why they're being called temporary, because they're not expected to have any long-term impact. And so it's not really surprising to see the structural force, the structural pressure from the CAD simply, in a sense, pushing aside whatever benefits the short-term measures might have generated.
How have you read the recent services data, Subir? Because manufacturing has slipped off alarmingly. Services were still growing out, holding out the growth to about a 5 to 6% kind of level till we saw the PMI numbers indicating a contraction. Do you think that has raised the risks, and how would you explain the kind of fall off that we're seeing in even service growth?
I'm sorry, I missed some of that question, if you don't mind repeating it.
I was talking about the recent HSBC PMI services number, which indicated a contraction.
I did register that, yes.
Yeah, so what in your eyes led to that, and does that raise the risks?
Well, I think the PMI is for the month of July, so it's really the middle of that month that we had this effective monetary tightening, which, as I said, basically is reflected in the fact that rates have gone up. So it's I think premature to correlate the two completely. But the PMI falling below 50, first time I think in at least as far back as I can remember, does suggest that industrial sluggishness is already in place and will perhaps be reinforced by the tightening. 1 month's observation is a bit too early to make any sort of firm judgment. But what it does, I think, is to reinforce the general perception that industrial activity, manufacturing activity in particular, is very sluggish, and we really don't see any significant factor either in place or in anticipation that would boost it. Now, I think if we step back a few weeks, the one factor that was perhaps contributing to some optimism was the continuing easing on interest rates, which was a possibility and a trajectory that had been set up before the currency dynamic changed. And that now has, at least for now, been taken off the table, which obviously changes the perception, the expectation of how industrial activity or how manufacturing activity will actually recover, because you need to see some force inside, some credible force inside that will allow it to turn around, and that at this point clearly is not visible.
Okay, let me ask you a slightly long-winded question now, Subir, because that's the heart of the matter. When India's growth went up from 5 to 8-9% in that period that it did in 2003 to 2007-8, there were very benign global tailwinds in terms of liquidity, and that point has been made that India's growth is quite leveraged to inflow of global capital. In a scenario where liquidity is tightening globally and over the next few years we might have less money coming into emerging markets, do you think it's a given that we can reclaim those 7-8% growth, or can we go back to averaging 5% growth again for the next many years if global liquidity reverts to a pre-2002 kind of an average?
I think you're absolutely right that the 2003-2008 period performance was partly, but not entirely, contributed to by very benign global conditions, both on capital inflows and particularly, I think, up to about 2007, very low oil prices. Keep in mind that oil prices were $30, $40, $50 a barrel for much of that period. And that, of course, then allowed inflationary pressures to be kept in check. We had an inflation problem towards the end of that period, but for the first 3 or 4 years, it was quite benign. We're in a very different situation now, both from the global capital scenario and the domestic inflation scenario. So both factors are actually going to be very different in terms of their impact on growth compared to the pre-crisis period. But what we have to really focus on is the proximate cause of that growth. I think it's very important to keep in mind that during that period, the investment to GDP ratio went up from sort of average over 25-26% in the preceding maybe decade to 38% very quickly, very sharply, and that reflected a number of things being done to get the investment environment in shape. Very important in this was the fiscal consolidation. We saw revenue expenditure, the revenue deficit being shrunk, and more money being spent on capital. I think that was very important, and that's a lesson we have to keep in mind now. And of course the balance of payments, which basically was a very low current account deficit, surplus in 3 of those 5 years actually. So we've got to recapture some of those macro grounds, and there are different strategies that we'll have to think of to achieve this, but I think we can't lose sight of the enabling factors from the macro front, and these are the 2 very critical ones, or 3, let's say. Low inflation, which of course now is related to the food economy, balance of payments under control, essentially low current account deficit, and a fiscal, both the deficit and a composition, which means more money being spent by government on asset formation. Now obviously getting back to this is going to be very difficult, but that has to be the focus and that has to be the priority.
Subir, a pleasure talking to you as always. Thank you very much for your time today.
This is Network 18. And you are watching CNBC TV 18.